Well, good morning, everyone. I'd like to welcome you to this morning's webinar on understanding captives. My name is Kim Steele, and I'm the Director of the Employee Benefits Department for the Partners Group. I am very pleased to introduce two very knowledgeable people on this topic, our guests, Kate Moore of C2 Solutions and Jeff Fitzgerald of Innovative Captive Solutions, or ICS. So with that, I'm going to go ahead and turn it over to Kate Moore, who will give us some more information.
Great. Thank you, Kim, and good morning, everyone. As Kim said, I am Kate Moore, CEO of C2 Solutions. I'm very happy to be here today to talk about the C2 Group Health Solution. And before we get started, I wanted to talk about who C2 is, and just to help set some context and share some information for those of you who may not be as familiar with the C2 organization. C2 is a six fiercely independent employee benefits firms across the country who are equal owners of C2 Solutions. We have M3 Insurance in Wisconsin, Kistler Tiffany Benefits in Pennsylvania, Scott Insurance in Virginia, the Carolinas, and in Tennessee, McGowan Brabender in Ohio, Holmes Murphy in Iowa, Texas, Omaha, Kansas City, Colorado, and Phoenix, and then, of course, the Partners Group here in Washington, Oregon, and Montana. And what's interesting about these six firms and why they came together to really be collaborative and also to be smarter, faster, stronger together to bring better solutions and value to the customers. So when you think about what our core purpose is, it is about that collaboration across the member firms, but also with carriers, our PBM partners, technology partners, all for the benefit of bringing greater value, as I said, and quality and value to our clients. So here we are. We have a national presence. We do not compete with each other, which really creates a great environment for sharing and for innovation and for thought-provoking conversations. So who is C2 in terms of numbers? And I think this is important when you think about a national presence. You know, we serve over 1 million members, and we also managed collectively over $3.5 billion in premiums. So we're a very we're a national organization, and one that our distribution partners really see as a great partner in terms of bringing their products to market. And with that, it also helps us leverage that relationship to be innovative and to create new solutions for all of you. So when I say like-minded, I think that's really important, especially when we talk about captives today, because captives has a lot to do with being like-minded as well. But when you're like-minded, you see the world in a similar fashion, you have similar goals. And again, when you think about coming to market to be faster, stronger, better together, what that means for you is that brings proprietary thought leadership together. There's peer-to-peer networking across many levels of these member firms. So not only at the principal level, but also consultants are peer-to-peers. We have healthcare reform across the six firms, marketing, communications, service. They're all peer groups talking to each other, again, sharing best practices and solving and creating solutions. What I want to sort of just speak to on this slide that I think is most important is not only the local intelligence and spotting those emerging trends, but the carefully vetted solutions. And I think when you bring six very sort of like-minded visionary firms together, when you talk about, like, for instance, the C2 Group Health Solution is one of those that was carefully vetted and brought forward. But there are also things that we did not bring forward, and I think that's where you can have some confidence in knowing that we are really having our customers first and foremost when we bring solutions to the market. So again, the power of our partnership is really about bringing the enhanced service and leveraging those relationships across the six member firms and our strategic partners. So today we're going to talk about the C2 Group Health Solution, and these are the partners that C2's brought together to bring this solution to you. So today we're going to spend the majority of our time with Innovative Captive Strategies with Jeff on understanding the financial underpinnings behind a captive. The other partners on the screen, I'll come back around after Jeff to talk about how we influence risk with our other partners that work with C2 on a regular basis. So with that, I will hand it over to Jeff.
So, good morning, everybody. Thank you for being here. As Kate said, my name is Jeff Fitzgerald. I work with Innovative Captive Strategies, or ICS, and really my part of the presentation today is to try to help explain the financial flow of funds, if you will, of the captive. And really, this is, I think, important for you to understand how this works, really so that it allows you in the future to focus on the partnerships associated with C2, with the partners group primarily, and then the vendors of clinical risk that are part of the program that really make the financial way it works worthwhile. So a little bit about us is, what we do, and really all that we do are involved in what are called group captives. On the employee benefit side, which we're here to talk about today, we currently have 10 different employee benefit captives, about 150 members, and about 45,000 covered lives or employees on plan. That doesn't include dependents and everything else. While that's a great story, what I'd ask you to think about from this regard is that 5 years ago, we really had one captive and 3 members in it, and now we have 10 and about 150, 160. And while that's great to share our growth, what we're really most pleased with, and we hope that why groups such as yourself might look at a captive, is that our persistency, meaning the members who stay in our captives, are upwards of 95%. So while growth is always great, for you as a long-term possible participant or member of one of these captives, the persistency should really be the thing that we ask you to think about, and that we're trying to generate as much as we can. So if you think of the regular health insurance world right now, the majority of groups in the sort of 50 to 500 or 100 to 300 life groups are really in a challenging position, and that the increases that you're getting year to year may or may not have any basis in fact, and you may or may not get any information or transparency in terms of what's driving that. The only real control you have is to look at how you may change your plan design, or basically how much cost shifting you put back to your employees, or what network you might change to. But there really isn't a ton of control you have on a year-to-year basis as it gets towards renewal. Likely feel that you're too small for self-funding, if you know what that is. And then on top of that, without getting into any specifics, healthcare reform over the past 10 years has been a roller coaster that no one's going to get off anytime soon. So really, it's through no fault of anyone who's on the call, but you really don't have any options, and it's just frustrating. The health insurance world right now is an unsustainable marketplace that's only getting more expensive. If you think of it another way, that health insurance itself is continuing to rise by anywhere from 8 to 12% a year. You as an employer or an employer who is making decisions about your employees have very few options, and they really come back to either shifting costs to the employees, absorbing the cost yourself, or reducing the benefits that you offer. And what I would say is if you're reducing the benefits that you offer, and we've all done it, you're basically just shifting costs back to your employees by another name. If you're not addressing the claim or the cost of the claim, then essentially all you're doing is deciding who's paying for the same thing every year. So a little aside, one of the ways that I think of this, and actually one of our clients mentioned this to us, if medical trend is 8 to 12% a year, it's going to be a little bit higher, a little bit lower in some places, and most of your employees are expecting a 3 to 4% cost of living increase, they're actually making less money over time. So really, the options that you have, while if you look at it year to year, maybe although challenging are swallowable, if you look at over a series of a long period of time, it really is unsustainable. And you, as what we call a mid-market employer, 50 to 500, 100 to 300 life groups, you really have two different ways from a financing perspective to address it. is you either stay fully insured, as most of you are, I believe, which is you're paying premium every year to a carrier and really walking away, right? You don't know what the claim is. You don't really know how to address the claims, but it is at least simple, if not expensive. On the flip side of it is you could go self-funded or self-insured, which is where you are responsible for paying your own claims. And the challenge with that is while you have a significant amount of flexibility, while you do get a reward for good years and have access to claims information, the challenge for those groups when looking at that is, do we have the wherewithal or the ability to absorb the swings that are natural occurring for any mid-sized market group? What an employee benefit captive tries to do by its financing is be the middle ground between the stability that you are trying to achieve by being fully insured, but also offering the upside and the best practices and the transparency you can get in a self-funded environment. So we're really trying to use a captive, and I'll get into that in a minute, sort of the structure of it. We're really trying to use that as a buffer between the stability that you want, but also the upside potential that you can get in a self-funded group, because ultimately you want to be keeping as much money as possible rather than paying a carrier who's using it to pay other people's claims. So in any insurance program, there's two parts of it: financing risk, which I'm going to touch on, and then influencing risk, which Kate is going to get back to. And really this drives the heart of what the Partners Group has tried to do with the other C2 member firms in terms of finding the best vendors and partners available right now to really address some really unhealthy people in your population that normally you can't get to, and are driving not necessarily the cost, but they are driving the renewals and the challenges in the increase. So what is a group captive? A group captive is simply a group of companies that come together to form their own insurance company. Regardless of your coverage, whether it's liability, workers' comp, health insurance, warranty coverage, whatever it is under the sun, it's a group of companies of a like mind, we hope, that come together to form their own insurance company and take back some of their own, take some back of their own risk, but really take some of their destiny back. Questions that we ask members to think about: that are we a good fit? Part of it has to do with certainly your premium size, which is oftentimes driven by your own employee base size, 50 to 500 covered employees, or 100 to 300. But really, for as much as anything else about this, it really is about you and the intent and the culture that you have as a group. Entrepreneurial spirit that recognizes this is a risk-reward proposition. While there is tremendous upside you can get, that does come with taking a little bit of risk, and we'll explain what that is and how we try to mitigate it through the use of the captive. Desiring control, and that you can keep doing the same thing over and over again. You can keep making a decision 90 to 60 days before your renewal, but you're really not in a position to take control and manage what is, for most of y'all, the largest single expense after payroll. And I would look at this the other way for most groups with population. Your payroll and your health insurance are parts of the same piece. I would imagine that most employees of yours do not separate payroll and health insurance. It's all part of your benefits package. While the often quoted of health insurance being the single largest expense, the reality of it is it's the single largest expense because it is factored into payroll in terms of why groups go to you and why groups leave you. Lastly, as much as I want to focus on the financing because I want you to understand it and feel comfortable with it and hopefully get excited about it so that you can have conversations with your Partners Group consultant, ultimately what this comes down to is care. And I don't mean the cost of care, I mean about caring about your employees. Groups that are focused solely on the financial aspect of these programs do not provide a ton of value to the other captive members, frankly, nor to their employees. Groups who do care about the health of their employees, how to help them get better, specifically folks that are unhealthy and don't know a way out and they're stuck in the insurance system, which we try to help with. Those are the best performing groups, and really those are the ones that are happiest in the captive long term. So I'm going to speak specifically about the financing risk. We recognize there are going to be some questions that pop up from this. Normally we say we're very, very conversational in this. Today's not the day. That being said, though, we will try to get through this in time to not only answer the questions that do come up and people type, but also what we find is that if you have a question somebody else does, and we can circulate that back through all the membership as a follow-up. So I'm the finance guy. Kate's the one who's really talking about how all the work gets done. So the way in which a captive itself works is that each individual member, each individual employer or company would be self-funded on its own with their own individual self-insured retention. And so what that means is, if those who are not familiar with it, is you as an employer would effectively take a deductible anywhere from $25,000 to probably $75,000. I think the highest we have is $100,000. But essentially, you would take your own internal deductible for every individual claim up to, let's say, $25,000. Obviously, there's flexibility with that, but let's just use that as a number. So any claim that goes below that, any outpatient arrangement, any small-time inpatient, all of the doctor's bills, all of the except for serious issues, all of the day-to-day prescriptions that people take at hospital visits, doctor's visits, those are all going to be claims below $25,000. You would purchase a stop-loss policy from Tokyo Marine HCC, who is one of the partners that Kate mentioned, that would essentially pay back all claims once they reach above that level. So, if there is a $50,000 claim, you are responsible for the first $25,000 of that. The stop-loss carrier is responsible for the claim from $25,000 to $50,000 and exceeding into that. Because of the Affordable Care Act and whatever its successor is or is not going to be, the reality of it is you have now claims with an unlimited lifetime liability. So the reality of it is that any claim that goes over $25,000 that used to go to $250,000 or $500,000 due to medical inflation can now go to millions or in the millions of dollars due to the removal of the cap on lifetime liabilities. So a regular self-funded group buys a stop-loss policy from $0 to $25,000 and $25,000 up within the regular stop-loss world. What the captive does is essentially takes the buffer layer between $25,000 and $250,000 and is shared among all the membership. Okay? So the reality of it is in health insurance, your health insurance cost is driven by the claims that go below $25,000. The cost of your insurance is driven by claims that run at below $25,000. We call that frequency or utilization. The effect of your renewal, the increase you get from one year to the next, is really driven by what happens between the $25,000 and $250,000 layer. Most of the time, those are claims that are unavoidable. Most of the time, those are claims that are unavoidable, and actually the way health insurance works is they resolve themselves relatively quickly, or they're chronic and you don't know who they are and you don't know how to help them. So what we're doing is using the captive layer to be the buffer layer. If there's 20 members in a captive in any given year, I don't know which 2 or 4 are going to have a challenging year as it relates to claims in the higher utilization layer of $25,000 to $250,000. I don't know who it's going to be. But I do know it's going to be probably a different group every 2 to 3 years. And the reality of it is, in the regular health insurance world, when that happens, you as an individual group are essentially pulled out of the regular pool you're in, slapped not on the wrist, but really against the shoulders, and given a high increase, and that becomes your new norm. All we're trying to do with a captive is flip that paradigm and has the captive itself as a buffer layer to protect you in the year in which you have a bad year, not to punish you. If we can get like-minded groups together that feel some accountability to each other, then and we can have them feel that they're in a protective environment, rather than you're only as good as the claims that you cost the carrier the next year, then your renewals and your experience in the program should be much flatter, should be much more level than you'd have right now in the regular, what we call mid-market 50 to 500, 100, 300 life groups. The other way to look at it is, as we call it, is the mine, the ours, and the theirs layer. You're responsible for your own utilization, and long-term, working with the partners group and working with the C2 firms, we can help address that. Okay? The ours layer, what we help you with is the captive layer, which is that layer between 25 and 250,000, where really the clinical risk components and the outreach components that are baked into the program get built in, because the reality of it is a $25,000 claim can easily go to 50, and that 50 can easily go to 100, and the 100 it can easily go to 200, and that's how it works. It's by multiples, it's not by addition. Okay, we want to put you in an example where we can stop those claims before they happen, or once they do, they don't run amok. If they do happen, though, then you're in a safe environment where everybody shares together, and that's the ours layer. So I'm going to run through a claims example. Like I said, there's a lot of questions that come from this portion of the presentation, and we want to make sure that we address it. But what I would say with this is just let us walk through it, and then we can go back through it depending on time, and then also on an individual follow-up for anything we might have. Okay? So we're going to take a member firm that's paying, for example, $1 million. It's not because we think you're all paying $1 million. It's just that, frankly, I'm not super bright and the numbers are pretty easy. So if you go back to the mine, ours, and theirs layer, if you think about it, and that in this environment, you would have an expected number of $600,000. That would be all the small claims that would add up underneath $25,000. Within the captive layer, you're going to have essentially $200,000, or 20% of that, going in the captive layer, and then the administrative fees, the partners group's fees, my fees, everybody else associated with it, as well as for the claims above $250,000 make up about $200,000. Okay. The other way I might ask you to think about it from a fully insured comparison, right now, if you're paying $1 million, you're paying $1 million. Let me say that again, because I know that's not revelatory. If you're paying $1 million, you're paying $1 million. What I mean by that is you have one large fixed cost. What a captive really is trying to do is take what is now a large fixed cost for you, and about 75 to 80% of that now becomes a variable cost to you. Okay? That doesn't mean you won't have claims, but it means you're starting at a much lower level, and anything above that you do not spend is money that you either save or get back in the form of a distribution. Okay? So if you think of the same example, you have $1 million fully insured, you have $1 million what we call a funding or premium equivalency, but it's broken up into mine, ours, and theirs layer. All right, or the other way to look at it then is, as we've seen before, mine is all claims below your own individual deductible. The ours is what's shared with all of the other member firms in the captive, and then the theirs, which is essentially administrative fees and high dollar and real high dollar claim is in the theirs layer. Okay, or your so if I take a group that has $600,000 in claims, which can easily happen off of $1 million spend normally, the way that would work normally is you would have $450,000 for claims less than $25,000 in your own individual utilization fund, and $150,000 that goes to the captive layer. That $150,000 claim can be, or $150,000 event can be one claim, or it can be a series of claims. From our perspective, we don't really distinguish between the two, but that's just the way that medical spend works. Okay, but in a normal self-funded environment, what happens then is that you have your $200,000 of expenses that we've spoken about. You have $200,000 in the captive loss fund, and you have $450,000 in total claims. So you, as a regular group, would save $150,000, excuse me, because you would have beat the expected number, which is always the goal, and only paid in $850,000 compared to the $1 million, example that you have right now in fully insured. But there is this captive thing. There is this piece that we keep talking about, trying to differentiate as a funding mechanism from what's out there normally in the market compared to fully insured or self-funded. Well, in this captive layer, if you are one of 20 members and you're putting $200,000 in the captive, so we have $4 million in loss funding, and there's a 90% loss ratio in the loss fund. And let me just say that real quick. We expect to have claims in the captive layer. It happens every year, okay? It's just part of the deal of why you buy insurance. And ultimately, you know, as much as I focus on the risk piece and the financing piece of it, you want those claims paid and you want them paid quickly, okay? One, not only because of how it affects your own balance sheet, but also, candidly, because these are employees and their families, and we don't want there to be any doubt or distinction that those claims are not going to be paid quickly, okay? But let's say that there's a 90% loss ratio out of this $4 million, and so there's $400,000 or 10% that comes back. You as an individual member may have a 5% share of what you're eligible for in the captive, so there'd be $20,000 coming back to you, right? So now what you're looking at is, as in addition to the $850,000 of total pay-in that you would have compared to $1 million example, you now have a $20,000 distribution that would come back to you through the use of a captive. So I said this earlier today, and it's something I'd ask you all to think about, because I think, well, this seems like a lot of work to talk about essentially saving 2% on a distribution in a captive layer, where I could just have my broker at the Partners Group give me a cheaper rate. And that's fair. It's fair and valid. But what I would make the argument with that, though, is that the reality of it is that there's only so many years you can find that 2 to 3% squeeze out of the fully insured carrier, much less on the fact that you could be saving 17% above what you've done before. On the flip side of it is, I would wager that each one of you as an individual employer have changed not only your plan design, but even probably your network and carrier on any one particular year to save 2 or 3%. We're all conditioned to do this. We're all conditioned to negotiate against an artificially, potentially, we don't really know, against what seems like an artificially high number to bring it down. What we're really trying to do in this is take all of that out and say, let's give you all of the upside you could possibly have and squeeze every dollar out of it and bring it back to you, because it's your money, not the carrier's money. If we did that, could we free you up to focus on the clinical risk component associated with really driving better utilization and better decisions with your employees who, frankly, right now don't have a lot of options in order to make educated decisions, so they really can't be blamed if claims run amok. One note about the captive, because the claims that you save in the $600,000 layer are savings to you. Money not spent is savings back to you off of the number that you were given. Since the captive itself is an insurance company and has to hold the money until claims are closed, you actually don't get that money back until the second year. Okay? So if you join in January, the program runs through December, we as the captive insurance company, on behalf of you, and we provide you quarterly statements on how the program is doing, as well as loss run experience to see. But we actually hold that money for 6 months to make sure there's no tail run associated with it, and then we would distribute that profit back to the membership. And actually, you would join an LLC, which is already up and running because we have members in this program. You would join an LLC, and that comes back to you through the form of a K-1 distribution. So, just as any rosy story has a great potential for savings, this is a risk for reward proposition, and so there are maxes that you have to be aware of. And for this piece right here, this is really where most groups who are looking at self-funded in that 50 to 500 or 100 to 300 range, this is really where most of them get very concerned about joining any self-insured vehicle, much less a captive. I understand that. As someone who has a stake in my own company's health insurance, we look at this the same way that you do every year. But remember, a captive is designed to mitigate or to lessen that swing that you would normally see from a regular self-funded group in one of two ways. The first is that, yes, there is a max exposure, which is 25% of what we call your expected or kind of set at rate. Okay, so in that $1 million example, if you're paying $600,000 potentially on an expected layer, you could swing 25% above that and have a max claims of $750,000. Okay, so another way to look at it is your swing is really going from the age 50 savings example, all in from the prior slides, to potentially spending $150,000 more than you might, or going a 15% above. On top of that, since the captive itself is paying claims and has to have protection for you, because it's possible, it's unlikely, but it's possible, we could, in this $4 million example, have $6 million in claims. We don't want to have to go back to any member and say, hey guys, while you did great on an individual, on your own individual example, we missed the number from your captive funding, and now we need additional money from you. Okay, we don't want to do that. It's obviously very difficult to renew the program if we're just asking you to sort of throw money into your insurance money pit. So what happens is then we ask you to fund what we call the collateral portion, okay, which is your maximum exposure under the captive, okay? That money comes back to you at the end of the 6 months, the same as your distributions would come back, okay? Another way I'd ask you to look at this, though, because I recognize that I've showed you all these great examples. I've got one slide to say that your world could be much more challenging, and then we're going to move on, all right? I don't want to overlook this, and I don't want to speak to it. But the goal that we set for most members coming in is that your max scenario should be 15 to, let's say, on a high side, 20% worse than where you'd factor coming in renewal on any given year on the fully insured. And I recognize for some of you, for all of you, that's a big number. I'd also ask you to look at it this way. The reality of it is, if you have a bad year, and like I said, a bad year it is unpredictable what the event it is for all of you. It's predictable in that it's going to happen. You can easily expect, especially now with healthcare reform and the additional penalties put on that, you can easily expect on a bad year, if trend is 8 to 12, you can easily expect that number to be 20 to 25%. And on top of that, that becomes the new normal. So if you get a 25% increase one year, your new normal is you're happy to get 8% the next. Well, over a 2-year time, you just got a 30% increase. And no one really paid attention and saw how that happened. Okay? The captive block of business is essentially, across all of our block of business, essentially works out to 5 to 7% from a renewal perspective. That doesn't mean that everybody had that. And it certainly doesn't mean that everybody had claims that would warrant those low renewals, but we're all in this together. We're all sharing in the joy and the pain together. And so essentially, your new normal is much lower than what you would expect if you're out on your own. in an environment where essentially you're just kind of waiting to see every year what happens. So I recognize it's easy for me to talk about your money as if it's no big deal to have these swings. But the reality of it is that this is still less than most of you would expect in the fully insured world, okay, if you look at what happens to you year after year. So as I talked about, so this is essentially something else to think about. It's collateral. It's the only other additional expense that members look at. For those accountants or non-accountants in the room, the reality of it is we hold it, although it stays an investment and an asset on your own balance sheet. But you either pay it up front or it's just billed monthly as part of the TPA billing that you have. So some of the objections and challenges that we hear that may be running through you is that, you know, we ourselves are a risk-averse company, and if you are, I applaud you. And to be honest with you, I'm pretty risk-averse myself. What I'd say to you is you've got to look at it one of two ways. Your risk aversion that you're looking to mitigate 1 month to the next is nothing compared to being essentially at the hands of carriers who are making decisions based upon your renewal, independent of how you're doing, except if you have a bad year. Secondarily, I think people talk about, well, I don't really want to share risk with others. How do I know I'm part of a good pool? And that's a very fair question. And the first question that I have back is, how do you know your pool is doing right now? Who do you think you're sharing risk with right now? You're part of a very large pool known as whatever fully insured carrier you have or whatever stop-loss carrier you have. You're sharing risk with them right now. The difference is you don't know what they're doing to mitigate claims. You don't know what they're doing to take care of each other. And you don't know what, if any, their long-term strategy is to address the claim and the cost of the claim, which is what we're about. The concern about, you know, mid-market groups having to hire someone else to do more clinical risk requirements, and, you know, do I need full-time staff to run a wellness program? The answer is no. But ultimately, if you are not, long-term trying to, okay, sorry, station identification. Long-term, if you're not trying to address the claim or the cost of the claim, it's going to be challenged. And lastly, the claims history. Most of these groups, we know we're not going to have much claims history on you. We're much more intent on writing and underwriting intent than we are with knowing everything about you. The reality is there are going to be some groups that are being grossly overcharged by the carriers, and then the majority of you are probably not going to be, but this is your best opportunity to get out of that. So I'm going to run through one case study of an actual group that we deal with, and then hand it back over to Kate, because really, like I said, as much as I like this, this is the least important part of the long-term program that you get into, but we want you to understand how it works. So this is a member that we have in the great state of Iowa, in one of our captives. They joined in 2013, and if you look at the 2013 column, they actually joined with the expectation of paying more than they were going to from their fully insured premium. So they were actually looking to pay 1.6 in the fully insured premium. We gave them a number of $1.85 million, and their actual cost came out to be 1.7. So not only did we tell them your expected cost was going to be more, but it could be less, it ended up not being. So it cost them more money the first year than if they had been on their own. They, through their due diligence with their insurance consultant, went to market. And the carrier gave them a relatively favorable renewal rate of $1.8 million. We came in $100,000 more than that. Their actual captive cost ended up being $12,000 less than what than what had been projected. So if you look at it over a 2-year period, I don't know if they really won, but they're a good partner. they had to make some real decisions based upon some claims that had happened. And thankfully, we had 2 years of data, and working with their consultant, we were able to pinpoint what was going on rather than feel that they were basically at the mercy of an unknown number. And so they were able to pinpoint and communicate with their members some plan design changes that were based upon educated decisions, not, as I talked earlier, based upon a reaction to a number they didn't like. But they went back to their carrier, and their carrier gave them another sort of trend increase of $2.3 million. We were pretty confident about the changes they'd made, and so we gave them a $2 million number. And they ended up coming in at $1.9 million, so they actually saved $400,000 that year. One of the other ways to look at it in that regard is that they had a very high claimant this year, plus some heavy utilization. What would have happened if they'd stayed in the fully insured world is that jump from 1.6 to 1.8 to 2.3 would have been their new normal. That's the new world they would have lived in, regardless of whether or not that claimant resolved itself. So lastly, at the 2016 renewal, they went back to market again. The carrier gave them a regular increase of $2.4 million. We gave them an expected number because we're looking at their claims. All they have to do is pay for themselves, plus help the pool when needed. We gave them a number of 2.1, and their actual captive cost came in right at $1.8 million, or $591,000. Okay, so their cumulative savings compared to the treadmill they had been on before versus being in this program, even taking into consideration their first year, it was not a slam dunk, and you could even make the argument their second year it wasn't, is nearly $1 million. And we have lots of those stories of groups that we deal with every day. The Partners Group has them as well. On their regular self-funded book of business, the challenge that you have with it outside the captive is that when they do have those bad years, the stop-loss carriers do create swings that are just as high, if not much higher, than the fully insured market. If you look at the orange line versus the purple line, what we're trying to use the captive to be is a trend controller, or a means to be a shock absorber for when those bad claims happen. Because what happens in 2014, a member has a bad claim year. In 2015, their health insurance premium skyrockets. Okay, it's a lagging indicator, not of the health of the population, but of the carrier's attempt to get its money back. Okay, but if you compare where they started in 2013, where they end up in 2016, all that we did. Let me back up. We didn't do it. All that this member did in working with their consultant was bend their cost curve down. All that the captive is and all that we do is provide the resources for them to be able to do so, first off by the financing mechanism, and then what we're going to transition to and right now through the influencing risk portion of the clinical risk of how you can outreach members that are sick, get them feeling better, and then long-term how that drives wellness in the rest of the population.
Great. Thank you, Jeff. So as Jeff mentioned, what we want to talk about is the other partners that are supporting the members in terms of influencing the risk. So we're going to start with just some of the headlines. I mean, I think that these are commonplace today where you hear about drug costs and specialty drugs and risk pools. But I think what's interesting is that the top 10% are nearly 2/3 of that population spending. And from a Kaiser Foundation, they do a great deal of very educational surveys, and this identifies that certainly the top 5% of the population is what drives 50% of your cost. So what we're trying to do is bring some partners to the table to help influence better outcomes on that 5%. We're going to start, though, with the pharmacy benefit in that C2 partners with Rx Benefits, and they are a pharmacy consultant, and they have a book of business that serves over 1 million members, and they manage over $1 billion drug spend. So when you have that working for you, it then provides access, service, and value that you wouldn't normally be able to have access to. So when you think about the access, because of the volume, we have the C2 Solutions captive has the top three PBMs. So we have ESI, CVS Caremark, and OptumRx that we can use with each of our members for their programs. In addition to that, we have a very high-touch member service experience. When you think about where these large PBMs spend their time, it's really on the very large customers that are 10,000 employees and higher. We believe that the membership in these captives as well as the C2 organizations really need to have that same experience, but at the middle market space. So Rx Benefits provides that fully integrated model and service model. And then finally, it's the value. And what's important here, when you are in a fully insured environment, pharmacy is bundled in with medical and so on. So you really never get you don't get an understanding of where the margins are, where the costs are, and how the contracts are negotiated. There are additional players. You've got the PBM, you have the wholesalers, you have the carrier, and all of that adds to the cost that comes through the fully insured premium. When you carve it out and you start to compare the contracts there are many elements in a contract. There are, the cost of mail service, generics, retail, and so on. When you do a comparison, on average, we are finding 18 to 22% savings on those contracts. And in addition to that, not only once we find those savings, we also audit those on a quarterly basis to make sure that the PBMs are providing those discounts and rebates as contracts require. So when you think about it, there's a cost trend and a service element to this relationship with Rx Benefits. So we are leveraging our purchasing power. We have access to these improved rebates. We understand our trend much better from the analytics and the plan designs, and they work with you on adjusting formularies and so forth. And then you also have this very dedicated pharmacy member experience. Let's talk now about Nova Solutions. So back when I talked about the 5% of people driving the over 50% cost of healthcare, when you think about that, it's really the utilization and the medications and so on can be used. The utilization is free or tends to feel like it because they typically go fill up their out-of-pocket maximum. So when you think about some of the opportunities for savings in an environment like this, as well as helping these sick people get better, you really need to have a very centric approach. So we bring to the table through Nova Solutions a very dedicated clinical support team that has a nurse, a pharmacist, and a medical researcher. And what that does is it provides information and education to make better decisions, but it brings data analytics and reporting so we can really understand what the outcomes are and what's happening here. I want to call out the fact that this is a voluntary program, so you only pay by utilization. It's not straight across the board. And we have found in our captive environments that we have a return of 3.5 to 1 on these investments, which really shows about a 10 to 15% reduction in your medical and drug costs after a year. Let's move on to oncology. We all know that there's a lot of diagnosis of cancers that exist, and each one of those are complex in their own right, and they are ever-changing. It's a very specialized care that's needed, and it's a very emotional, it has an emotional impact not only on the patient but the families as well. So it really requires a very specialized approach and a patient-centric approach to help these employees and members really get through this experience in a positive way. So we bring, again, it's a care management team of oncology nurses and support teams. We really not only talk about the education and support that the individual needs, but also the family as well. Once you think about just the care that needs to take place, there's a lot of claims that go through the system, and they need to be managed and audited to make sure that there's no misuse or fraudulent activity going on. So you have someone on your behalf really helping you get through some of just the paperwork that has to happen. So when you think about that, not only, again, is it very patient-centric, but we're also finding savings in this program as well. And then finally, we have added Interis into the C2 Groups Help Solution. And as you know, Interis is a partners group consulting practice that really has a data analytics to help population health management. So bringing that into the captive not only helps us understand each member firm's claims experience and what those insights can be, but also in an overall captive as well. So when you think about that, we bring together a whole host of partners to not only help you build a financial platform on the financial side, but we also have the programs and partners in place to help you influence that risk on an ongoing basis. So with that, we are going to open this up for questions. And I think we have a chat box here.
We do have a chat box, and currently we don't, actually we do have a question that just popped up. Let's take a peek at that. How are the captive populations made up? Is it based on SIC size or dollars?
Sure. So right now, what we are discussing is what we're calling the C2 Group Health Solutions Captive, and that is going to be made up of clients of the Partners Group as well as the other C2 member firms. We are not right now separating them by SIC code, as you might be familiar with in the property and casualty captive world. Or dollar spend. We really are pretty firm about having 50 to 500 groups. We really have trouble going below 50 employees, and we really have groups that are over 500. Frankly, just have then groups that are over 500 just have a lot more benefits they can get on their own. Excuse me, it shouldn't be so hard to say. So really right now what it is it's called a heterogeneous program where it really is working with the partners groups and the other C2 member firms to populate that, recognizing that somebody who is in a very high utilization industry versus a low utilization industry either because of their work or because of their actual demographics, we can price for the difference. Every group is going to have swings in their claims. Just because one group has a lower utilization cost than another one doesn't mean they don't have the same type of swing.
Great. Thank you, Jeff. Another question has come up. What incentive does a company have to implement a higher specific deductible? And kind of getting into that concept of what's mine.
Right.
Can you tell us a little bit about that?
Absolutely. So if you think about it, most groups over time, as they get more comfortable with the program, they're going to increase their own individual specific and aggregate deductible. I gave the number as $25,000 to $50,000. That's really where a lot of groups start. But as they get more comfortable, they may want to increase, have a higher mine, a lesser ours. The way that I look at it from a captive is if you want to take more risk on your own and you're really driven by utilization, that's fantastic. Although the captive itself is a very efficient vehicle, there is frictional cost associated with it in the form of some of the fees. So if you want to pay less premium and take that more on your own, that's fine. So from our perspective is the incentive really is back to you, and that it's how much risk you want to take. And what you do find over time is that groups do bump that up a little bit on their own.
Perfect. And then how is the total specific and aggregate calculated per company?
Sure. So there is a calculation which is based off of your enrollment, and that I gave the example of $600,000, and then your total worst would be $750,000 in that example. That all gets broken down to a per employee per month fee or attachment point, the same as your fee right now is for your stop loss premium. So you would get a bundled rate that it also has all the broken out pieces of it, and that would be calculated. And we can do it single family, 2-tier, 4-tier, however you want to do the same as you see right now.
Okay, thank you. And does each captive only have one singular plan design?
Right. And so that's a great question, because I think when you talk about buying in bulk, that would be the thought. And the answer is no. Each group can make their own decisions regarding plan design as well as their own plan design changes. You do find that groups start to migrate towards more commonality as they share best practices and with each other. But really, from our perspective, is we can price for the differences one way or the other. And ultimately, those are questions that we would rather there be much more strategic and long-term in terms of what your plan design changes are, rather than reactionary as it may be right now. But the reality of it is each group can have their own.
Perfect. Thank you. And we're right up against our 11:30 time frame, and we don't have any. One question just popped
I like
up.
that.
So let's do. So what would inhibit a company from putting in a rich benefit plan and a low specific and shifting a lot of risk onto the captive?
So there isn't anything that inhibits them. Just recognize if you have a very rich plan design and a very low spec, you're going to be paying more in fixed costs than somebody else might. So if you want to do that, that's totally fine. You may have a higher fixed cost than somebody who doesn't. Okay? So where that does show up a little bit more is, remember, we do share claims reports with each individual, with all the members together. And if you're consistently, as a member, charging more than you're bringing in, then that does show up. And that is a difference between having just a bad claims year and having a plan design that's designed to take advantage of everybody else. So first off, we underwrite for it, and the more benefit your plan design is, the more you should expect to pay. Secondary to that is if your benefit design is set in such a manner that you're being subsidized every year rather than everyone getting their fair share, that does show up, and then that's more of a membership conversation about should they mandate different plan designs based upon who is being a good neighbor or not.
Great. Thank you. Well, with that, those are all the questions that we have, and we're right on the nose at 11:30. I thank everyone for attending our webinar today on captive. I know that both Jeff and Kate have shared with us a lot of information about this innovative strategy. So thank you again for everyone on the line. If you have any questions, please don't hesitate to reach out to your Partners Group representative. We are here to help. And we will be sending a copy of the recording to everyone here in the next couple of days. Thank you again for attending. Have a wonderful day.